Stocks are tracking for yet another record close. Here with her best ideas on positioning at these lofty levels is SoFi's head of investment strategy, Liz Thomas. Nice to see you.
Nice to see you, too.
Best positioning right now in the market, again, we're going to have record close, we think, is where?
Well, I've been talking about for a while investors needing to diversify their growth and momentum exposure. Obviously, we've had long periods of time where growth stocks, momentum stocks have led the market higher, but now embarking on what is set to be a reignition of a Fed cutting cycle, I think this broadening out trade really does have legs, and I think it's got legs through the end of the year if we're going to get more cuts. So when we're looking into the Fed next week, first of all, the devil is always in the details, and you want to be looking at that summary of economic projections for what they think is going to happen by the end of the year. But this broadening out trade should be an opportunity in small caps, although I would use the equal weighted S&P for that exposure, because actually during cycles where the Fed cuts because they can, large caps still tend to perform really strongly. So you don't want to walk away from that exposure. And then sectors like healthcare, financials, and even energy at these levels.
So you don't care necessarily about 25 or 50 next week. It's the start of the trend of multiple rate cuts over time that lets that positioning work.
It's right. It's the message that they're starting on this normalizing rates process again. So I don't think we're getting 50 next week. I think the market is ahead of itself by thinking that. And actually, we lowered the pricing of that as the day went on today. It would be really difficult to explain 50. I think we get 25. And I think we continue to get increments of 25 unless the data starts to really fall apart. But what we're obviously all looking at right now is the labor market. Yes, there's weakness in the labor market, but absent some sort of crack in corporate margins, corporate earnings, there's really no reason that some big layoff cycle should start to take place. So it's okay that the labor market is cooling, and actually an unemployment rate at 4.3% is still below where the Fed thinks it's going to be at the end of the year. They had it pegged at 4.5%. So there's room for the labor market to cool further before I think they get uncomfortable.
If Chair Powell sounds a little bit dour about the economy, certainly the labor market, but still leads us to believe that he's cutting, does that still work for stocks, or do we sell the cut thinking like, well, we may have some economic period of uncertainty, if not more weakness, that we're going to have to contend with?
There's always a risk that in his messaging, he talks about some sort of weakness and the market thinks, uh-oh, they know something that we don't know. And I also think that if the market continues to hope for 50 basis points, there could be a disappointing reaction day of the Fed meeting, maybe the next day. But in reality, we don't want them to start cutting because they're forced to cut. We don't want them to send a message that they're cutting because there's weakness that they're concerned about. I don't think that that's what we're going to get from him next week. I think we're going to get a message that's more along the lines of it's appropriate to loosen policy a little bit here because of some of the data that's come in our dual mandate. But I still think that they want to wait for the inflation data for more in fall to really make a decision on what to message.
I got you. Sorry for stepping on your toes.
It's okay.
Last question. You suggest to buy software on dips. There's a point of contention in that. I mean, can you be more specific on that and why you think, I know you can't name names of actual stocks, but why you think you should do that? Because some suggest the disruption from AI on a good portion of software could be profound.
Right. Well, so earlier this year, when I came out with my 2025 outlook, I talked about software being the next conduit for AI. I still believe that that can be the case, and it should be the companies that help put AI into place and really bring it to life. So when I'm saying on dips, it's because, yes, their valuations are still high in a lot of these names. So you do want to take advantage of times when it's pulled back. But I think investors are looking for other opportunities and other ways to invest in AI outside of a lot of the headline names that have been mostly in the semiconductor space. So if you think about AI as a longer term theme, and themes being somewhere between, let's say, 3, 5, or even 10 years long, we've still got a big runway in a lot of these other names that have not really benefited yet from the theme as much as semis have.